But the one in focus is Tata Metaliks. They're going to be merged with Tata Steel Long Products. So let's try and understand what exactly is the merger math, etc. going behind this. Sandeep Kumar, the MD at Tata Metaliks, joins us on the show right now. Sandeep, hi, good morning. Good to have you on ET Now. Firstly, I wish you a very happy Diwali and Happy New Year from all of us.
Thank you, and same to you.
Thanks. Okay, Sandeep, just wanted to understand, tell us a little bit about the merger. What can shareholders of Tata Metaliks expect?
So we have announced the merger swap ratio. So for every 10 shares of Tata Metaliks, which the Tata Metaliks shareholders hold, they will get 12 shares of Tata Steel Long Products. So that's almost 1.2 times. So that's been, basically the swap ratio has been worked out by independent valuers as per the SEBI regulations, and we have followed their guidelines.
Sure. I also want to understand what exactly are the merger synergies like, and also how exactly does the product portfolio of the two companies really match, because Tata Steel Long Products makes long steel and specialty steel, while what you're into is pipes. We understand that your Redi unit will also be utilized.
So the major synergies will be on the upstream side, because up to hot metal stage, it's the common process. So whether it's the iron ore, coal, coke, fluxes, then the blast furnace, that's a major cost element of that. So on the cost side, there would be major savings and synergies. Then, of course, on the market side as well, there would be some synergies, for example, on the supply chain, distribution, etc. Yes, the customer segments are different, but then that's true for us even today when we have pig iron and ductile iron pipe businesses. What this merger does is to build scale, and of course it simplifies the portfolio of the parent, Tata Steel Group, and we try and consolidate our business into specific areas. So that's the overall benefit, and I think that's what you would have heard from Tata Steel and as well as from the group chairman of Tata Sons.
Mr. Kumar, can you also tell us about the raw material sourcing and the integration of the supply chain?
Yeah, so, the raw materials, the major cost element for a hot metal, almost 60 to 65% is coming in from coke. Now, coke capacity of Tata Steel Long Products, they have some excess capacity. And we have a shortage, we buy from the market. So immediately there is a synergy of getting, transferring coke at cost from Tata Steel Long Products, which is based in Jamshedpur, that unit, and we are in Kharagpur, which is hardly any distance. So it brings in a lot of synergy on the raw material. Then we buy coal, coking coal, which is mostly imported. Again, there can be synergies in terms of procurement. Of course, part of the synergies were already being realized because Tata Steel as a parent was in any case helping in that entire process. Similarly, iron ore. So you have a lot of synergies on the raw material sides, on the procurement side, on the MRO, and on sharing of knowledge, people, reducing the common functions. So I think there would be tremendously high synergies on the upstream side. On the downstream side, we will have to, of course, we will continue with our businesses in individual specific segments, but there would be some synergies on distribution, supply chains, on stockyards, networks, etc., etc. So we will need to, detail this out as we go forward. This has just been announced more from a regulatory point of view. So we will let you know more and more as we go forward.
Sure thing. And, given the fact that the company is debt-free, you have a positive EPS, now this merger will be an indebted company. There's going to be a loss at the bottom line as well. So what is it that would be in store for shareholders in terms of some of these important metrics?
Well, you must appreciate that Tata Steel Long Products, was basically the company earlier was called Tata Sponge, which was a highly profitable company. It acquired the steel plant of Usha Martin of Jamshedpur only a year and a half back. So obviously with the investments there, last year you would have seen negative on the bottom line. But as we go forward, even this year, I think in quarter two, Tata Steel Long Products has done very well. And, they have, if you see their numbers, they're very, very, very positive EBITDA. So it takes a bit of time to convert, any acquisition into positive territory. And they seem to be doing that quite well.
On the national infrastructure pipeline, there is the water for all scheme as well, and a huge pipeline that we're looking at. So what's your order book, your revenue outlook looking like?
So the ductile iron pipe business. Yeah. Sorry, can you hear me?
Yes, go ahead.
Are you able to hear me? Yeah, okay. So the ductile iron pipe business, as you know, is a more stable, long-term and more profitable business. We have had some issues with the government investments, on the infrastructure, water infrastructure side, which is after COVID. So we have seen some slowdown over the last, I would say, in fact, over the last 9 to 12 months. But as far as our order books are concerned, I think we are having almost 9 to 10 months of order books, which is pretty decent. That's the average, order books that you would at any point in time want to have. So we are pretty much on that. The issue at this point in time is more with the flow of those orders in terms of execution because of, I think some slowdown in terms of money flow from the government. I would expect that over the next 6 to 12 months, this would get sorted out as the government is also quite committed to create demand stimulus. And I think infrastructure, particularly water infrastructure with the health and hygiene aspects, comes very much top on their agenda. So there is a bit of a temporary slowdown in terms of actual order flowing into execution part. But order bookings, they are pretty decent.
Okay, great. Thanks so much for joining us this morning and taking us through the latest there.
Right. Thank you.